Okay, welcome back. So we've got to a kind of natural point here in the video series where we've basically taken in a hell of a lot of information and really dug quite deep into the whole overall approach and systematic process to the Forex markets. And I know it's a lot to take in, there's a lot of information there, but you've just got to stick at it. And no one said this is going to be easy. A formalized professional trader or hedge fund manager overall investment process or trading process, these systematic processes that are so common across the whole financial spectrum on the professional side, they're not easy to get a handle on to begin with, but you just have to get used to operating in this way. And the best way I can advise you to do this is when we were obviously going through the foundation and the endogenous analysis, there's a lot of process there. And what I definitely advise you to do to really kind of get yourself up the curve now is just really concentrating on practicing it like crazy. Just practice the spreadsheet work, downloading the data, practicing over and over and over again the processes that you have to go through to crunch the data, and stay on top of your processes on a weekly and monthly basis. Because practice makes perfect. Trading is just like anything else, whether it's sports, going to the gym, or riding a bike. Once you get your muscle memory working, you will go back to it by default, and you'll start being able to do all of this with your eyes closed, and you'll be able to start doing it very, very quickly. And you'll see that actually these processes and what you get out of them, the returns just become exponential because you're spending less time doing it and getting more out of it. And now basically coming to this section, we're going to do a recap of everything just to make sure we've got everything in the process cemented, and also a recap on approach, the overall process, and the principles that we've actually picked up along the way. So the first thing we'll do, we'll go over to the computer screen and we'll collate all the information that we got from the endogenous process that's relying on our foundation that we got very early on. And we'll scorecard the entire endogenous analysis, and we'll see what we come up with for the United States. Then, after we come back here briefly, we'll go back over to the computer screen and just make sure, we'll go over the approach that we're taking here to remind ourselves of everything that we're doing and why we're doing it. We'll look again at the overall investment process as a quick recap, and then we'll look at all the principles that we've picked up along the way. Then we'll come back here for a conclusion on everything, and then we'll head over to the next big section of the video series, which is going to be the exogenous analysis. That's when things start to get a bit tasty, because up to this point it's been quite mechanical and methodical. With that, we're now going to go later into the exogenous process, and the exogenous process continues to be mechanical and gets a little bit more complicated, but all of these things start to come together and you start seeing all the reasons why we do all of these processes, because the answers start coming out. And okay, let's go over to the computer screen and we'll do a full rundown of the whole endogenous analysis and the full scorecard for endogenous. Okay, so welcome back to the computer screen. What we're going to do here now is go through the entire endogenous scorecard. And this is probably the moment that we've all been waiting for. It's taken a lot of work to get here, but everything has to be explained thoroughly and formally. And as I said earlier, once you continue to go through all these processes, you'll be able to scorecard each of the processes, each of the indicators as they come out every week, every month. And you'll be able to put them into your scorecards and overall scorecards and systematically see how things move over time. And that's what it's all about. Obviously, the scorecard is going to change over time as indicator readings change as well. So as you can see, we're in the endogenous scorecard section here. Next door is our sources area, and we have all of our drivers here in the endogenous analysis. Now let's start going through everything here from column to column, so we understand everything that's going on here. In the B column, we have the names of our drivers. We have the sub-drivers. So for example, in leading indicators, we have our sub-drivers for ISM manufacturing, NMI services, consumer sentiment and building permits, and the rest are down here. We have our codes. We have the actual rate and reading that we've got from the latest number. We have our scorecard for inflation or deflation. We have our state. So we have a qualitative statement here of the state of the driver and the score. In the middle, we have our total score, which we'll come to much later on. Try to ignore that for the moment. We need to concentrate on the process of how we get there right now. We have a comment on the state itself. So overall qualitative comments on what we're actually thinking. And we have our sources here. Our sources are also next door and available in the sources tab. So as you can see, we've plugged in all our rates all the way down. And next door, we have our scores. So we picked up our scores along the way as we were doing the process. And then we have what the score is actually out of, a maximum. And we have our total score here. The scale that we need to understand is that a maximum score for maximum inflation is going to be 160. And the minimum, so the absolute minimum that we can have as a deflationary score is minus 150. And that is because we can't score positively for the interest over GDP. That's just always going to be a deflationary number, as we picked up along the way. The full scale is going to be from the biggest absolute minus number to the biggest absolute maximum number. The full scale is 310 points. And equidistant between here is the half scale, which is 5. And our score has come out as 36. So basically, we're airing to inflation in the United States. And because we're getting an inflationary reading here, it's obvious that in our overall scorecard, on an endogenous absolute static basis, we're leaning towards a short currency bias in the US dollar. But what's also important to understand is our qualitative analysis, because we have to understand what's driving this score and where it can likely move in the future. So in each section, you'll see qualitative statements in the comments area, but there's also group statements for each area. So for example, in the surveys section, we concluded for surveys that we have overall mild inflation. GDP is forecasted by leading indicators 6 to 12 months from now to show 2 to 3% real GDP growth. We have deflationary threats from possible peaked ISM, NMI, UMCSI, and we also have a potential deflationary threat from an overall lackluster housing market. because the housing market has been going sideways since 2003. Now, when we go to the next section, we have our money supply, interest rates, and inflation. And we have all items numbers for CPI and PPI and our food and energy numbers. The conclusion that we get to overall is that there's some quite serious deflationary effects occurring due to the oil price in the all items readings. And we've also noticed that in the money supply, there have recently been 2 lots of 30% plus annualized prints. And we know from our filtering process that the prints of above 30% are generally associated or correlated to economic GDP contraction and historical economic crises. So we have to ask ourselves the question here. We have deflation across the all items numbers, and we also have deflation creeping in potentially to the food and energy numbers, to other items in the economy. And we're also getting evidence from very low interest rates and from aggressive front door M2 printing that the Fed is actually acting. So we need to bear this in mind. We get on to the next section. We have our employment report, and we look at this in its entirety. And we know that the 12-month rolling percentage is pretty normal. And we may have actually seen a peak in jobs growth because the absolute number is very high historically. When we move on to the next section, when we're looking at balance sheets and sovereign risk, the conclusion we get to is that central authority action overall is extremely inflationary, and there's deflationary threats. The conclusion we also get to is that the Fed is sponsoring government debt with low interest rates and QE. But now the QE program, the last QE program, QE3, has ended 6-7 months ago. And we're starting to see deflation in a lot of our other economic numbers. So, for example, when you completely ignore balance sheets and sovereign risk as a contributor to our overall score, let's have a look at the scores for all of our drivers outside of central authorities. So we're looking at everything on the left-hand side of our overall economic map of variables. And the middle, we're looking at the coincidence indicators, so leading and coincident. What have we actually got here? Well, you can see that we have some mild inflation in the surveys, but a lot of our numbers are actually deflationary or zero. So what we've got is some mild inflation numbers, but a lot of zeros and deflationary numbers. So most of our contribution to our inflationary numbers are coming from our balance sheet and sovereign risk. And our deflationary contribution is coming actually from one of our leading, but mostly our coincident indicators. And our leading indicators may have some deflationary threats from peaks. So it's very important to understand and look at this objectively, what the overall score is and what this process is spitting out, but also the qualitative analysis, because the qualitative analysis can tell us where this is likely to go in the future. So when we look at this overall, we have a 36 on the sliding scale of -150 to +160. So we're getting evidence of overall inflationary conditions. Most indicators outside the central authorities are normal to deflationary. which is not good. Evidence of central authority action outside of QE from the M2 money supply, with those two 30% annualized plus prints, are potentially replacing QE. Combine this with low interest rates. Basically what is happening is low interest rates and the M2 money supply is potentially being used by central authorities to counter deflationary threats like the price of oil, and is managing to keep government ticking over. So it's actually pretty amazing that this whole process that we've just been through has giving us a very vibrant picture of what is occurring in the United States economy overall. But we're also systematically scoring this extremely objectively. So what's our conclusion here? Our conclusion is that the US dollar now and in the future is more than likely to actually lose its purchasing power on an absolute basis. So we're looking to have an inflationary short bias overall, but our conviction is not extremely high at the moment. This is just our absolute backdrop of what we think is probably the right way to go in the vast majority of cases, now and in the future. So now that we've come to that conclusion, let's go back over to the office breakout area, and I'll see you in a few minutes. Okay, so welcome back. I hope you fully understood how we went through everything there. And I hope you do always remember that this is an endogenous analysis with a static absolution principle. One of the best ways to think about this actually is to think of when we're analyzing the United States and the US dollar, just think of that as the entire world. So there is no other currency. And the currency that you and I hold in our hands as the US dollar, that currency is exchanged for goods and services. And if the market has injections and is overall flooded with more and more paper, then obviously that paper loses value. And if there's deflation, so the prices of goods are going down, the paper that we hold in our hand is worth more. So what we're doing here is looking at it and critiquing this very objectively on an endogenous, static absolution principle. And the reason why we build this foundation like this is because it's rational to do so. Before we start comparing two countries against each other, we need to look at those two countries in isolation, in absolute terms, because we want to know if their currency is actually increasing in value or decreasing in value, given everything that's going on at home, without any outside influences. So we're doing this because systematically, as professional traders, we have to stay objective, we have to build our foundation and go through rational steps to arrive at our answers. And this is part of an overall investment process. So think of this in terms of the examples that we gave earlier in the foundation, where you're basically investing your money into a trader or a hedge fund. Do you give your money to a guy who punts around on Eurodollar once a month around the NFP number because it might miss or beat expectations at the consensus level? Or do you give your money to somebody who has the 1 to 3 month time horizon, long short, has an overall rational investment process, and has a 7-year solid track record with diversification and volatility controlled in their overall portfolio? I think you know the answer. It's very, very straightforward. So the conclusion we get to here is always, well, if you wouldn't do it with your own money, giving it to somebody else, why would you give your money to yourself and do it in the way that retail traders do it? You have to start doing it like this and start getting up the curve and practicing, and going through all of the processes and making sure that you update this every week, every month. So now we're going to leave the endogenous analysis. We're going to move on now to a quick recap of the approach we're taking here, the overall investment and trading process, and the principles that we've picked up throughout the video series. Putting all these things together now is really important before we move on to a lot more complicated stuff, because we really need to cement and understand this stuff now before we move on. We don't want to forget what we've picked up along the way here, and we don't want to forget what our foundation is. We've arrived at this point now, and we just need to make sure that we understand everything before we move on. So let's go back over to the computer screen, and I'll see you in a few moments. Okay, so what we're going to do here is go through a brief rundown and recap of all of the main areas and things that we've picked up throughout the video series. I think it's a good time to do this because a lot of the information throughout the video series so far will be new information to you. And do bear in mind also that we've actually taken in a hell of a lot of information to this point. And we just want to basically cement all the main things that we've picked up so far to this point. And a lot of these things that we've picked up really drop into three main areas. The first one is approach. So the approach that we're taking to the international Forex markets. The second thing that we've picked up along the way is a formalized investment or trading process, our systematic process. And the third thing that we've picked up is actually along the way, we've picked up a lot of principles that we have to stick to within our approach and within our investment and trading process. So let's start with the approach that we're taking here to the Forex markets. And let's go right back to the beginning of the video series. If you remember, right at the beginning of the video series, we outlined our objective here. And the objective is to provide retail Forex traders with a systematic approach to predicting future currency pair moves in the same way as professional traders and hedge fund managers do, so retail Forex traders can implement the same approach. And what we did was we first went about this by trying to understand the limiting factors or parameters that retail traders face and why they consistently lose money, or why so many of them consistently lose money. And we seek basically the opposite approach and seek the approach of professional traders or hedge fund managers. So we went through this in foundation as we were picking up a lot of understanding about the way the Forex markets actually work. So first of all, understanding these limiting factors that retail traders face and put on themselves, and understanding why they consistently lose money. And by understanding all of that, what we're doing is basically laying a foundation of how not to do it. If we understand how not to do it, then we protect our downside. And therefore, we can open up our upside by seeking potentially the opposite approach. And what we begin to realize when we look at the professional world and the way Forex market infrastructure works is that the opposite approach is the professional trader, hedge fund manager approach. So the first thing that we realized was that we need an awareness of this infrastructure, and we need an awareness of the main culprit of the infrastructure in retail and why retail traders consistently lose money. And the main reason is conflict of interest. So first thing we have to do, and we laid out, is we have to be aware of the conflict of interest. Being aware of the conflict of interest and how everything works across the Forex markets and across the retail Forex market within the infrastructure, being aware of the conflict of interest gives us an understanding and foundation on which we can build. And what we quickly realize when we analyze how all this works is that we basically have to ditch the dumb money approach. So this idea of basically operating within infrastructure that we believe has been built for the benefit of the retail trader, when in fact it's not been built for that reason at all. It's been built for the opposite reason. It's been built as an infrastructure to make other people money. And the dumb money approach of basically just accepting the way that these people want you to trade. So we're talking primarily here in the retail Forex world of retail brokers and educators pushing you into strategies and ways of trading the Forex markets in the way that they want you to trade so they can get paid and not you. So being aware of the conflict of interest and ditching the whole dumb money approach. So this then enables us to move on to embracing and opening up our minds to another way, and opening up our minds to the professional trader, hedge fund manager approach to the Forex markets. Because what it really comes down to is, as a retail trader, you'll be putting an amount of money into a retail Forex trading account, and your objective is to make money with your own money. So what we realize is that our objective is not aligned with brokers. It's not aligned with generic educators who teach day trading strategies so they can get paid. It's understanding the Forex markets properly and using our own money to grow our money consistently. So we don't want to be one of these people that blows up very, very quickly. We don't want to be one of these people that consistently loses small amounts of money and it takes them a long time to blow up, but in the end, they just blow up. We don't want to be the person who deposits money in their Forex account, has a one-hit wonder, makes some money on one trade, then loses it all. What we want to be is the person that deposits their money into their trading account and grows their money consistently, and you're able to do this consistently forever. And we'll come on to principles a bit later, but for now, what we're doing is embracing the approach so we can actually open the door to this happening. And implementing it yourself without any outside help basically means you're deploying the self-starter principle, which we'll come to in a little bit, and becoming consistently profitable over your lifetime. So by knowing all of this in the foundation, what we're doing is we're allowing ourselves to build the foundation of understanding of the Forex markets. And this in itself provides a bridge between understanding the Forex markets and our systematic process that professional traders and hedge fund managers, all professional traders and hedge fund managers, actually construct and deploy. So when we were building out our foundation, we obviously picked up a lot of information in terms of our approach along the way when it comes to things like defining an opportunity set for the asset class. So in this case, Forex, defining for Forex the differences between currency regimes, the actual infrastructure, which again we've touched on here, and the computational methods that we apply to the Forex markets. So both basic methods and also the more advanced methods in assessing volatility. So we picked up everything we need in our approach within the foundation. And the foundation has allowed us to really understand and zoom in on what we need to do. And this is pretty key. Basically, getting rid of everything on the right-hand side and embracing everything on the left-hand side. So embracing long-short portfolio management of 1 to 3 months, seeking diversity and risk management, looking for long-term consistency and looking to preserve and grow capital, because that's the outcome that we want. Everything on the right we need to ditch. We want to get rid of directional day trading. That's what people with conflict of interest want us to do, because that's what gets them paid and not us. And that's totally evidenced by the infrastructure and the way Forex markets are set up, and also the way in which computational methods are directed. So the way in which retail traders are directed to believing that a few basic computational methods is your answer, and also in terms of volatility. We know that the opportunity to make money in the Forex markets on a one-day basis is very, very limited. This is what people with conflict of interest want you to do, because they get paid from doing this, not you. And concentrated risk. We want to get rid of the concentrated risk in our trading books, because we don't want to place all our bets on one situation or two situations, because it can quite easily go wrong. We want to get rid of short-term binary. So we want to get rid of looking at one economic number or two economic numbers as panacea numbers that we always trade on. We want to have an overall systematic approach that makes us long-term consistent, that we can apply to the Forex markets consistently forever at any one point in time. And we obviously don't want our outcome to be capital destruction. So we get rid of day trading, we get rid of directional trading, we get rid of concentrated risk, we get rid of seeking binary outcomes. Because the only outcome, if you put all these three things together, is capital destruction. So we want to embrace everything on the left-hand side, get rid of everything on the right-hand side. That's the general approach we get as we go through our overall foundation and understanding of the Forex markets. And obviously, when we're looking to understand the basic underpinnings of the Forex markets and get our foundation, we pick up and embrace a lot of the professional trader and hedge fund manager approaches just by seeking the correct foundation. That allows us then to open the door to actually build our systematic process. And then we actually started to build out our systematic process in the same way that professional traders and hedge fund managers construct their own systematic processes and deploy them. So moving on from approach now to the investment and trading process. And again, this is an overall systematic approach that the viewers of the PTM video series will be very aware of, because this applies across all asset classes, and specifically in the PTM video series, the WISH framework applies to stock markets. What we're focusing on here is currency markets in the middle. So we actually apply the same approach, but the approach is simply tweaked. The systematic process is tweaked for the nuances and behaviors specifically of the Forex markets, because although a lot of the drivers for stock markets and currency markets overlap in macroeconomics especially, there are specific drivers that we have to look at and focus on within currency markets themselves. So we zoom in on the currency markets and we get a feedback loop at the top level occurring because our macroeconomic views on currencies will drive our worldview, which can actually drive our views on other asset classes like stock markets, commodity markets, and also bond or interest rate markets. And when we break this down, we break it down into the four main areas. We have our idea generation area. So exactly the same way as we do it across all asset classes. Our idea generation area first. And in currencies, within idea generation, we have three main areas. We have our drivers that are leading indicators that lead the economy and predict. We have our coincident indicators that lag our driving indicators, and they sit in the middle. And these coincident indicators are actually affected by what's on our right-hand side, which are our monetary and fiscal levers or drivers, and they are reactionary and committed to affecting our coincident drivers. We go through this whole process of the endogenous and exogenous analysis, and this is fundamental idea generation. This generates our fundamental ideas to buy and sell currencies, and our process here spits out our fundamental longs and shorts. What we get when we come to the end of the idea generation process, and by the way, the idea generation process is actually always ongoing. It's constantly occurring when you're a trader. But when we spit out our ideas from this area, the idea generation phase, what gets spat out, the output from the idea generation phase, is our fundamental predisposition on currencies themselves. And then we move on to basically cleansing these ideas, and we move on to timing. So we move from our fundamental predisposition to timing. And we have our second phase, the gatekeeping process. The gatekeeping process consists of our commitment of traders analysis, our technical analysis, and our price action analysis. And technical analysis and price action analysis comes within our watch list implementation. And then we actually have real positions. So what we're looking at here is driving fundamental ideas, having fundamental predispositions, which we then time correctly. Our next phase of the overall systematic process is to overlay our ideas and our timing and our real positions with discipline and risk management. And discipline and risk management gets driven in exactly the same way as we assess opportunities, through volatility analysis, through distributions and ATR. We also have risk management principles that we apply to our overall trading account and portfolio. And then we also assess our ability as traders and constantly ask ourselves the questions whether we're making or losing money. And regardless of whether we're making or losing money, where do our strengths and weaknesses lie? What do our own numbers as traders, when we critically analyze ourselves, tell us what we're good at and what we're bad at, and we always try and get better. So far, we've looked only at the fundamental idea generation process. And we're going to move on to later gatekeeping, risk management, and self-awareness statistics. So far, we've got our endogenous analysis, which is basically everything in pink. And we're going to move on to our exogenous analysis, which is everything in green. And then we're going to end up with fundamental predispositions in currencies themselves. Now, along the way, throughout our foundation and throughout our endogenous analysis, we've actually picked up a lot of principles along the way that we want to always never forget. we always want to keep these principles in the back of our mind and stick to these principles throughout our trading career or lifetime. So we've got to cement these principles and make sure we fully understand them. The first one is that all professional traders or hedge fund managers formalize their investment or trading process in a very similar way to the WISH framework and the individual asset classes, in this case, currencies, within the framework. And they also have their own inputs to the overall process. And this is quite important to understand. So there's a couple of things we need to go over here. The first one is if you go to any proprietary trading desk at an investment bank or a hedge fund, and the better example here is to probably use the hedge fund. They both have very, very similar processes in terms of their systematic process. But using the example of the hedge fund, if you go there as an investor to invest money in a Forex hedge fund, a Forex fund, what you're going to find is that, first of all, they formalize their investment and trading process. Secondly, when they first pre-qualify you as a serious and sophisticated investor, they will then, secondly, make you sign an NDA, non-disclosure agreement, which enables you to then legally see their investment and trading process. And their investment and trading process, the vast majority of the time, probably 80% of hedge funds, will have a very, very similar overall process to the WISH framework and the individual asset classes, so currencies here, within the framework. So they'll have the idea generation phase, overlaid with gatekeeping, so timing, overlaid with risk management principles, and they will critically analyze their own fund with self-awareness statistics. So that's the first thing. The second thing is that they have their own inputs to the overall process as well. So the great thing about having a systematic process is that if you break it up as trade idea generation, gatekeeping and timing, risk management and self-awareness, in each of those four areas, you can actually add your own inputs to the overall process. So when we look at our systematic process here, it gives you a fantastic guide and a fantastic basis for taking the right approach. But you can always add your own inputs to each part of the overall process. So first of all, formalizing and having an investment and trading process in the same way that the WISH framework and the individual asset classes within the framework have. And secondly, allowing the systematic process to actually become more sophisticated and change over time if it needs to. So it's actually a flexible approach. And the best traders in the world are the most flexible traders because they move with the times. And we learned this as well in volatility. If you seek volatility, you go where the money is and you go where the opportunities are. So the beauty of a systematic process is that it's formalized and the inputs can change and you can add more and more inputs to the overall process in each area. So that's the first principle that we've picked up along the way. Specifically in currencies, trade ideas are generated by utilizing a top-down fundamental macroeconomic analysis, and this formalizes a worldview, and it tells us whether to be fundamentally bullish or bearish on the US dollar. Then we can become bullish or bearish on each currency in our tradable set because we can apply the same endogenous analysis to every single currency in our tradable set. And we end up with a fundamental predisposition of whether to be bullish or bearish on a particular currency in the same way that we did with the US dollar. And then what we do is we optimize by pairing up the most bullish with the most bearish. And we have to remember that the US dollar is just one currency in our tradable set. However, when we include it in the video series here, it's important because our macroeconomic view on the United States and the US dollar is one of the biggest inputs in helping us to formalize our overall macroeconomic worldview. So our view on everything that's happening in Forex markets and the world at any one point in time, because the US dollar is the world's reserve currency. The next principle we picked up along the way is one of the big ones, obviously, which is that volatility is everything to a trader. And this is why in currencies, we actually systematically rank volatility across our tradable set. So we know where volatility or opportunity exists, and we seek to trade volatility on longer timeframes. So our analysis of volatility actually tells us that the optimal time period for trading Forex pairs is on a 1 to 3 month time frame. And we always, again, have to have the principle in the back of our mind that our job as traders is that we are actually just slaves to volatility, and we have to transition our approach dependent on volatility. So when we're using our systematic framework, if in the future volatility over certain time periods and in certain currency pairs changes, we have to actually morph our process to take account of this. So a lot of principles we picked up there. Some other principles that we picked up along the way also, one of the main ones was one that we touched on just a little bit earlier, was that we are absolutely self-starters. And we mustn't forget this. It's so important as a trader to be a self-starter so you don't rely on other people to provide information for you. Because the most probable situation when you're starting out as a trader in the retail Forex market is that the person you're dealing with or relying on for information is going to have a conflict of interest. So we have to go into this from the outset with a self-starter mentality that we're going to do everything for ourselves and only rely on ourselves and seek out our own information. So we have to stick to this principle. Another thing that we are going to look at briefly here, and this is in the same vein as being a self-starter, is we don't look to trade currencies or any other asset class for that matter for income. Because when we've analyzed, in particular, the Forex markets, we know that this is just a fallacy coming from people who have the conflict of interest. We trade for consistent long-term profits. We build our trading accounts up using our own money consistently and patiently over time, and we build our net worth. We don't look to trade our money in the currency markets, try to make quick money on a daily or weekly basis, and then take that money out of our accounts to pay our rent, mortgage, or our car financing deal. We build our net worth, and we keep our money in our trading accounts, and we use the financial markets to actually get wealthier and build our net worth. We don't rely on our trading accounts for income. By doing so, we're relying on the market volatility on very short time frames to pay us within a specific tradable set. So we just don't do that. We're self-starters. We know how the Forex markets work, and we seek to build our own net worth by using information that we get ourselves, not relying on others for the information, and building up our wealth and net worth in our trading accounts over time. In terms of resources, in the same vein as being a self-starter, we try to make money with very little resources. We don't go out and pay people for softwares that tell us when to buy and when to sell. We don't go out and pay excessive money for data and excessive money for services when it's all out there and it's freely available. We try to make money with very little resources, so Excel and the internet, by utilizing publicly available information. And the key is learning how to interpret it correctly. Because even if you know how to get the information that's important, it can still be useless to you if you don't know and you're not educated enough to understand how to interpret it correctly. And then we turn our interpretation into real hard dollars through our professional systematic investment process. We take the minority of information that is relevant, and through our process we stay objective and we cut out all of the noise and bullshit in the market that we hear on a daily basis that doesn't mean anything, that doesn't help us in any way to make money, because we know most of the time it's coming from an agenda. It's coming from media with an agenda. It's coming from conflict of interest, and they work together to control the agenda. It doesn't help us. It's noise. We go out and we get publicly available information. We use the internet to get it. We get data. We crunch numbers in Excel. We stay objective. We interpret the numbers and the data correctly, and we turn it into real hard money. And in between, we don't listen to people. We don't need to, because the numbers speak for themselves. We always stay objective. So we've covered the approach there. We've recapped the investment and trading process, why we do things and what we've done so far. And we've covered all of the main principles that we've picked up along the way throughout our foundation and our endogenous analysis to this point. Let's go back to the office breakout area and we'll do a quick recap and we'll move on to exogenous analysis. Okay, so welcome back. We're going to just tie everything up here now from the first big section of the video series, foundation and endogenous analysis. What have we picked up here in the recap? Well, with endogenous analysis, you're just going to practice, and you're going to update it, and you're also going to apply this to every country or currency in our tradable set, and also, if required, any country you choose in the world, because this process can be applied to anything. It can be applied to any country out there. And when we move on to exogenous analysis, we'll be looking at the Australian dollar versus the US dollar, but you're going to have to go out there yourself and you're going to have to do an endogenous analysis on the Aussie dollar itself and all other currencies in the tradable set. Why? Because we're basically self-starters. We don't rely on other people for information. What we're doing here is showing you the process that professional traders and hedge fund managers go through, and you're going to have to repeat it. That's your homework. So that's where we've got to on endogenous analysis. Touching on our first principle there of being a self-starter, we also understand and we know conflict of interest and how the Forex market works. We also understand volatility and that it's a trader's best friend. And volatility creates opportunity, and without opportunity we cannot make money. Without risk we can't get opportunity, and without opportunity we cannot make money. So risk is absolutely going to happen. You can't avoid it, but we'll understand later how we control it. We're also sticking to the principle of utilizing always publicly available information and free resources, because we're self-starters and we don't rely on anybody for information. So our two main tools so far have been Excel and the internet. We can go out online and we can get any data we want to get if we really want to get it. You've just got to search high and low for it. One of the great resources that we've been using all the way through has been the St. Louis Fed website. You can get that data from a lot of different sources, but it just happens to be all in one place, or not all of it, but most of it in one place. So that's pretty convenient for us. When you move on to other countries, you're going to find that it's not as easy as the United States. That's fine. If you're like a dog with a bone and you want to get the information, you will go and find it. Even if you have to pay a little bit of money for it, it's worth getting. Because once you have the data sets, you have the data sets forever, and you just have to update it when the new numbers come out. And we use the information that we get properly. We interpret it properly. We interpret it through an overall systematic process, and we do it with statistical rigor. We work it out properly, and we know what the interpretation is. We know what it means. We know the difference between an inflationary and deflationary number. We know the difference between an absolute number and a base number. We can see through the smoke screens now, and we can see where conflict of interest lies and how these smoke screens are created. And what we do is all the time, when we're sticking to our principles, is we just always eliminate the noise. We look at everything objectively. Eliminate the noise and be objective. Okay, so let's not labor the points too much, but if you have to go back and watch through the principles again, please do so. Pick them up. They're really important, because once you stop dropping these principles, you turn into a lazy, dumb money trader who's always reactive and always loses money. And we don't want you to be that. We want you to be the total opposite. So let's move on to the next section, exogenous analysis, and I'll see you on the other side.